very good afternoon to everybody. I would like to thank each one of you for joining us in this afternoon session titled Role of Guarantees in Bridging the Unaddressed Credit Need. It is my pleasure to invite the esteemed panel for the session. This session is co-curated in partnership with NSDF. The session is moderated by Nat Malupillai, Independent Consultant, former Director, India Programs, NSDF, and the panelists include Arup Kumar, CGM SIDBI, Subalakshmi Chakraborty, FinReach Solutions, Vineet Sugumar, MD Vivriti Capital, S. Vishwanatha Prasad, Founder and Managing Director, Caspian Impact Investment. Over to you, Nat, and the floor is yours now.
Great, thank you so much. So welcome and good afternoon to everybody. It's been a riveting day this morning talking about nano entrepreneurs and access to credit. So we will explore more of that track with a very esteemed panel. We did introduce them. I'll do a brief intro myself, but everybody knows these professionals. I don't think we need a long introduction. But I really want to start with talking about MSMEs and specifically nano entrepreneurs within that, right? So we did talk enough about how we have about 63.5 million MSMEs, and about 98% of them are micro, and within that, majority of them are nano entrepreneurs. And for the sake of this discussion, we've defined them to be somebody with a turnover of less than 1 crore, right? I mean, that's kind of the nano, which is a huge segment, right? And the lot of documentation, even the report that was released this morning, talked about how large a segment it is in terms of credit. IFC published a report that talked about about a 20 to 25 trillion gap, right? We currently have about close to 20 trillion of outstanding that's serving the segment, but still have a long way to go as we go down the list of nano entrepreneurs. And as we look at some of the challenges in serving this segment, right, there is a good reason why we as a financial inclusion or financial institutions have struggled. They've largely been informal and unorganized enterprises. So it's very difficult to get any kind of documented income from them. They frequently don't have collateral to offer a security. And these are things that banks are used to underwriting. So that clearly posed a challenge for them. And also some of these ticket size are very small. So cost of transaction went up, the risk and pricing framework didn't quite fit the framework that the large banks used as well. So I think that's probably one of the biggest problems that's plagued this segment of the customer. And one of the innovative ways to address this has been credit guarantee throughout the world. And it's not new to India either. We've been doing this in one form or the other from the 50s onwards, starting from export guarantees and so on. And it's evolved. I think the last year and a half probably made it even more center with the government coming up with this ECGLS programs, which was the predominant measures, the stimulus measures were in the forms of guarantee, which I think is apt in terms of what this segment needs. So the way I think about credit guarantee is it's a risk transfer tool, right, at the simplest form, right, and it really transfers risk from a lender to then whoever takes on this guarantee. And I think there are so many nuances underneath that very simple statement. And that's what I'm going to, go to the experts and talk about and so on. And, as we, think about this, and again, we'll go to each one of them. So we have Suva, of course, who is a professional banker who's done this for a very number of years. And she runs this FinReach Solutions, which is a service provider for providing credit, including guarantees and really offering technology and operations to them. So it'll be great to get Suva's perspective as we go through it. And Prasad is a veteran, and I've looked up to him in terms of credit guarantee and lending as such, specifically wholesale part of it. So I would come back to, hear Prasad's viewpoint on wholesale versus retail guarantee. And of course, there is no greater torchbearer for MSME lending and the CGTMSE than SIDBI and CGTMSE. So really, Arup Kumar, would love to hear your own perspectives and vision as to what should we do in this segment to help some of our smaller nano entrepreneurs. And then Vineet, I mean, he's got a very dynamic platform that actually does this, and an incredible amount of data gathering that goes on to then provide credit to different enterprises. What does he see? How does credit guarantee help in the capital markets? With so much of co-lending that they do, I'd love to, pick your brain on that. So these are things that I'm going to place before you, and I'm going to be, taking a lot of notes and really learning from you along with all the other participants. So with that, why don't we start with you, Prasad, if you don't mind, your own perspective, and then we'll go around the room from there on what do you think of credit guarantee from a risk transfer standpoint, and how do you deploy it?
Sure. Yeah. Thanks, Nat. And yeah, it's a very interesting subject, and also I think very, like you said, from a timing standpoint, seems very appropriate, at this time for us to talk about it. So if you just step back a little bit, like you very well said, I think we've had some form of guarantee, to enable flow of capital to enterprises, whether it is Exim Bank or SIDBI's own flagship product. But I think it is also as markets mature, I think we should see it as a very necessary and important infrastructure that a mature market like us, as we mature, we will need. Of course, we are today talking in the context of SMEs, and maybe that's a great place to start because we have history of doing it. So essentially, we should, I think of this as an important infrastructure that our financial system must have, and hence we must look at it. Of course, from a financial sustainability standpoint, it will also take time for it to settle and mature, both in terms of acceptable risk and price points, etc. So that is one. So I think we should see this, and of course, a fully mature market. If you want this as a key part as a market player, then we would want it in the private sector. So we should see where we are from that standpoint. And guarantees have been used, especially from a financial inclusion standpoint, in different forms to achieve different purposes. I mean, one is, of course, initially, if you see in the 90s, they were used by DFIs to encourage banks and financial institutions to do microcredit, where the guarantors had good confidence on the underlying credit, and of course, financial institutions had the liquidity. So that is kind of, I guess, from financial inclusion standpoint, we've seen that happen. And of course, in the current context where there is so much of liquidity, that is really not the constraint, but risk assessment and risk management is really the what guarantees tend to address. I think there is one, in my view, there's one big enabler that is changed, and I'm sure Suha and Vineet can talk about it, is how, especially in the context of MSMEs, how I think we can really write smart guarantees because of the technology that's available. So pretty much, the borrower, the lender, and the guarantor can have real-time information of a loan and hence the portfolios. So you can, I think that was virtually impossible, I would say, even 7-8 years ago. Today, all of us can see the underlying portfolio pretty much real time. So I think that has huge, potential to both in underwriting, in monitoring, collections, and hence pricing it appropriately. That's the enabler. From a market, I think, resistance standpoint, like any risk transfer, it will take a little bit of time, I think, for the market to pay appropriate price. Because when we take insurance, we always see that, okay, I'm paying this much premium, but I'm claiming much less, is how we tend to look at it. But if we are seen as something that is very much part of a retail financial institution, just like underwriting, just like collection, just like monitoring, and risk mitigation through guarantees are the essential aspects of how financial institutions are built to serve SMEs. I think that will be a good situation to have. We can discuss a little bit more about pricing and sustainability, viability, etc. But I'll stop there.
Sorry, I was on mute. Yes, thank you for that. So maybe this is a good segue, Mr. Arup, if you can, take a, give us a bit of a lesson on SIDBI and CGT MSc. How have the journey been so far? I think you are the, biggest advocate of credit to MSMEs, and it'd be great to hear your perspective. And the second part of the question also is, what else is a limiting factor today? We still have a huge credit gap. We'd love to also come back and learn from you. What should the industry be thinking about to extend this further to reduce the credit gap? So,
yeah, thank you very much. Good afternoon to all. A great topic. This is transfer of credit risk and is basically meant to facilitate credit, especially for countries like ours where underserved, unserved, they need credit. And what Mr. Prasad said, today we have liquidity surplus. So I was just thinking about this aspect also while he was speaking. 20, 30 years back, it was just the other way. And then also there was a need to have credit guarantee. Today also there is a need to have credit guarantee. Such a good two extreme situations, both needing credit guarantee. So while we know that it is to facilitate, to supplement credit, that we are having these guarantee programs all across. Initially, if you see when these things were not there, we used to talk about for normal MSME lending, personal guarantee, corporate guarantee. Now personal guarantee, if you have some worth, then only personal guarantee is meaningful for any lender. So, and then third party guarantee, collateral security. Most of these things, they are not available for the micro units, or so to say today when we are defining macro nano units. So access to credit, affordable credit, we all know this is a must for any economy, for a developing economy more so, because you can't have aspirational growth if it is not an inclusive growth. It's not going to be a sustainable growth. And so it is a must. And so all the government all across have been running these programs. We are no different. We started in 90s. This thought was there, which was given serious consideration. And in 2000, we set up this CGT MSME with the help of this Ministry of MSMEs. Ever since, the journey has been really very interesting. Initial years, it was not very, because that was a culture, new culture which was being brought to the country for the lenders. And so naturally, it had all the challenges, hiccups, and everything, even abuses, misuses, and all those things we have seen in the journey, especially in the initial years. Over a period of time, with the experience, has also industry also evolving, the ecosystem evolving, technology, credit bureau, everything. So many things have happened, whereby we were able to change the way it was being run. Now, risk sharing was envisaged even earlier. If I can go back to initial years, I very vividly remember that we used to deliberate internally that many of the lenders, they were covering all those government schemes, programs like PMRY and all for coverage. So we need to be very, very clear about one thing, that this is not loan against guarantee. This is loan without collateral security or third-party guarantee. What it means for the lenders, we kept on doing so much of information dissemination and engaging with them to make them understand this is this, and this is not meant to be taken as loan against a guarantee program. And so it is basically meant to be taken with all the seriousness which normal loans have to be taken in terms of credit underwriting, in terms of follow-up, monitoring, recovery, and everything. Then only such programs can be successful in our country especially. So with this, if you see the journey of 21 years of CGTMSE, what we have done so far now, member lending institutions, the type of lenders which can get, initially it was just there, some type of banks only. Now all types of banks today, they are part of it. Now extending it to NBFCs also, that is what. So more than, I would say, 120 plus MLIs are there whose loans are being covered under CGTMSE program. And statistics wise, cumulatively 32 lakh plus customers MSE customers, they have been supported, and trade flow has been facilitated to the tune of more than 3 lakh crore. So while I fully agree, 20 trillion supply, 25 trillion gap. So this is nothing as compared to that. But at the same time, this is, I would say, a good thing to happen in the country. This has facilitated really good amount of trade flow. And but at the same time, there is retail guarantee. This is not institutional, and there was a need felt for that. And with another ministry, which is our parent ministry, Ministry of Finance, with that, some year back, you have seen the setting of NCGTC. So National Credit Guarantee Trust that has been set up, which is taking care of the institutional, like you have seen the recent launch of CGCMFI. This basically this credit guarantee, so that in the plenty situation of liquidity, when the money is not going down, government wants to give this. So this again, that also has been introduced so as to take care of that. Besides that, for various sectoral interventions, like if you talked about ECLGS, we have partial credit guarantee for sub-bed, for other things, PM Swanidhi, that is all sectoral intervention, and from time to time, as per the need, that is happening. So I'll stop here with this as the starting point, and maybe during deliberations, we talk about further nuances.
Absolutely. Thank you so much for getting us started there. There are a lot of follow-up questions and we will come back to it. But I'd love to go back to Suva and Vineet and then come back. So Suva, you've been in the industry for a long time in different roles, and you have a very interesting role now. And what is your perspective, Suva, as you think about the role of guarantor, and then you also been a lender? So it'll be good to, put those multiple hats on and talk about how do you see their roles, and why would a lender, or when would a lender avail this product? What benefits would they get out of it? It'll be great to share your perspective there.
Thanks, Nat, and good afternoon to all of you. And it's been very interesting hearing so far Prasad and Mr. Arup Kumar, and the phenomenal job which CGTMSE is doing, and the other guarantee schemes, which is really helping the market. So if I were to kind of at this juncture just step back, and that, as you mentioned, that if I were to look at my 25 years of experience in the banking industry, working with very large banks like ICICI, or foreign banks like Barclays, etc. From that perspective, if I were to look at the whole, the structure of the financial or the credit markets, I see three kind of distinct players, a distinct category of players. One is, of course, these large banks and financial institutions, which has abundant liquidity and have all the intent to actually tap into India's growing and vibrant MSME, rural, agri economy, etc. But however, has a big challenge in terms of accessing the grassroots. I mean, really going and working very close to the grassroots, and also a bit of coupled with risk averseness, and focusing more on collateral-based lending. So these are some of the reasons where there is a restriction of the expansion of credit to these underserved, which is also what they would like to do it. It is not that the whole intent is there to do it. So this is on one spectrum. The other spectrum is obviously what we were talking about, this large unmet credit demand of this MSME sector, which is more than 25.8 trillion rupees. And, they are really, and they also have their own challenges of not having adequate collateral to really get to these, the access to the bank finance. And they are also very susceptible and very vulnerable to any kind of economic shock. The first, burnt is, faced by them for any kind of a sudden shock which comes in. And they also have funding crisis. Now, in between, there is this, these smaller NBFCs, these new fintech companies, this whole emergence of these, fintech players, etc. They have, a very close, they are closer to the grassroots, have much local reach out. They have alternate risk assessment models based on granular real-time and capabilities of assessing portfolios risk, and also the debt servicing capability of these enterprises. But they have limited access to capital, and they have limited access to both bank capital, capital markets, and the cost of capital is also expensive. So this is, I mean, the three kind of distinct players. And where I see credit guarantee coming is basically bridging this entire gap. So I see credit guarantee acting as a conduit for credit transmission to the MSMEs on one spectrum of the, on the one spectrum, and enabling these smaller entities, the MSME lenders, the fintech companies, etc., to expand their credit appetite, and also enabling improvement of their credit portfolio. So quality of the portfolio becomes better for them to have more access to the bank financing. So the banks and the large financial institution who want to, or who has the resources to really pump into the economy, they then can, backed by a kind of a credit guaranteed portfolio of these middle intermediaries, or these NBFCs, or the fintechs, and the MSME lenders, would be able to put their resources into these NBFCs, and the NBFCs in turn, with their access to the grassroots and their understanding of the risk and their understanding with the the whole platform and their sophisticated data analytics, etc., would be able to assess the MSMEs. And so this is in a very global way, I see that where credit guarantee. And now if you ask me that from a guarantor's perspective, so what is it that he or she is seeing or doing it additional, which a lender cannot do, or how is he adding value? So to my mind, when the guarantor actually looks at these various portfolios and expands the the guarantee facility, so with economies of scale and pooling of risks and diversification through aggregation of risk across geographies, the credit guarantor will be able to, in a sense, have a better mitigation and pricing the credit risk effectively, beyond which a single institution can do, because the guarantor is working across institutions, across geographies, across sectors. So that might help him to get a better kind of a diversification and better pricing. So that's where I see how the guarantors play a role. And you asked the question as to how this will help the lenders. I mean, of course, I kind of covered it in a broad way, that the lenders get a better access to the bank market, as also having a expansion of their risk appetite. But in a more structured way, if we look at it, the MSME lenders, with the help of guarantee, gets a downside protection of any unexpected risk. I mean, while they are kind of obviously pricing in the expected risk, but in case of unexpected event, they have a downside protection when you have a kind of a portfolio, a credit guarantee up to whatever percentage. Then they have cash flow support. That is another important thing. I mean, while some of these lenders may be giving even collateral based, but the loss, if the tenure of the loan is, let's say, 3 or 4 years, the underlying loan. So even after the borrower goes into an NPA or goes into default, the lender may ultimately be able to collect, repossess the security and collect to whatever extent the amount, but it will take a period of time, because the whole mechanism takes a bit of time. But here there would be an immediate cash support based on the of course the terms of the guarantee, that after X amount of period, I mean, if the loan has gone defaulted, then, the guarantor will pay the amount. And, I mean, of course, I mean, once recovery happens, then the amount again comes back. So that's an important that cash flows support. And I mentioned already that it supports business expansion because they can go into geographies and have some kind of a risk cover with this guarantor. And, I mean, it helps to expand its business, its sectors, its the tenor of the loans if they want to take a larger tenor, so that they get a kind of a back support. And of course, I mean, going forward, if you look at it from their balance sheet perspective, there would be a reduction because of the reduction in the expected loss, the ELC, the expected loss charge due to reduction of loss given default. There would be, they would get some benefits in terms of lower provisioning and eventually release of economic capital. So this, I would say, kind of, broadly the benefits that the lender might get. And I mean, I'll be happy to kind of listen to others. Thanks.
Great. Thank you. Thank you, Siva. That is a good exhaustive perspective. So Vineet, I want to come to you now. I think you have a very interesting vantage point as well through the platform that you run, and you work with several lenders. And it'd be fabulous to hear from you. How have you seen credit guarantee improve access to credit for some of the MSMEs? And really, what is the current limiting factor for this product to do more?
So Nat, I think I'll just take a step back and focus on the 4 potential roles that guarantees can play. Right now, guarantees can play a role as Mr. Arup Kumar said, on expanding retail itself, right? So expansion of retail is the core role that, for example, CGT MSE has played. A more private sector example is for example, what IMGC did with ICICI Bank, right? Where for mortgage loans, loan to values of 95 to 100% could be evaluated using an IMGC partnership. For a guarantee, today I understand that has significantly helped ICICI Bank in really expanding the retail book itself. It's a great case study of how credit guarantees can actually expand retail by allowing the lender to build credit history on a so-called slightly riskier book with the benefit of guarantees and then go all out. Right. The second example of how credit guarantees have been used, this is live on on the Credit Avenue co-lending platform, which is about accessing daily finance. Right. Today, until recently, co-lending partnerships have been hamstrung on account of 2 issues. One is the technology integration, and the second is the extent of first loss that either a fintech platform or an originator has to put up. Right? Guarantees can solve that. Today, RBI has come back quite strongly, and you must have all seen the new draft working paper for fintech, right? On fintech platforms providing such guarantees, right? And some of that may have to be phased out over time, right? And the gap can definitely be filled in by credit guarantees for consumer loans, for enterprise loans, for MSME loans, and so on. And that today is something which is digitally available on Credit Avenue, where on every single contract a guarantee can be attached, a partial guarantee can be attached to build more lender comfort and digitally move a large number of loans to the platform for co-lending. The third category is wholesale finance. Wholesale finance is a subject where we spend a lot of time as a house. There, credit guarantees serve as I would say, slightly imperfect substitute for a credit default swap. This is the instrument that is much more prevalent globally. In India, CDS has not taken off. We've seen some usage of guarantees as a substitute for CDS between 2014 to now. And it's been a fairly narrow market. But having said that, the value is very, very clear. It helps the rating of the exposure to move up, the capital usage for the lender to move down, and a higher volume of liquidity to come in. Right? It also opens up a category of lenders that borrowers may not have, and these borrowers have been typically NBFCs, but to some small extent corporates also. Right? And the fourth category is where there are blended pools of assets, which can then find a market in domestic and international markets. So these are like the domestic equivalent of CLOs, right? where static pools constituting of corporate loans and NBFC loans, right, on the wholesale side, right, are packaged together, wrapped with a partial guarantee, which can sharply improve the rating. And this can become a marketable instrument for global investors to take exposure into Indian markets, right? Again, something which my team has been working on. We've had some success in improving the rating of these papers to AA, AA plus, and AAA, and find both domestic and international appetite from very risk-averse investors like insurance companies, for example. Right. These are the four use cases that we see that we see for guarantees. 2 of them on the retail side and 2 of them on the institutional or the wholesale side. Right. Fundamentally, I think Subbalakshmi has said it all in terms of how guarantees add value to both the issuer, investor, borrower. So I won't belabor the point. Having said that, I think what we definitely need and what's holding us back is the absolute availability of guarantors, right? We don't have a regulatory mechanism for this in India. We don't have the ability, for example, for let's say alternate investment funds that can provide guarantees, which is possible internationally. We don't have a very clear framework for banks to provide guarantees. Banks are actually encouraged to lend rather than guarantee, right? And the capital treatment for guarantees is not great. We don't have a provision for NBFCs also to be encouraged to do this business. They can actually take higher risk and encourage other parts of capital markets to move. I think a lot more can be done from the perspective of a regulatory framework to support both guarantees at the retail level and guarantees at the institution level. Otherwise, the market will not get limited by either the availability of issuers and investors, but by the availability of guarantors.
Great, thank you, Vineet. I think that's a lot of points that to unpack. I think there's a great segue. These are some points that I had as pointers for questions as well. So I think it's a great way to take it forward. Maybe, in fact, there was an audience poll that we just did about what they thought was more effective, whether a wholesale guarantee or a retail guarantee. And I think it's not a landslide number, but 57% think wholesale guarantees are more effective compared to retail guarantee. So quick, go around the room as to what you think of it, and anything else that you would want to shed light on those, differentiation between wholesale and retail. So really, any of you, Prasad, starting with you, maybe.
Yeah, I mean, I think the numbers also, I think, indicate that to what Vineet just said. I think you need, you can use guarantees smartly or at either side. Depending upon what purpose it is serving, so yeah, I think it is effective. As a product, how it is structured. But my question, also would be to Vineet or to Mr. Arup is whether how do you see the market paying price for this? Where do you see the Indian market is? Because we do see, many of the government-led institutions basically charge a very narrow pricing. In the sense that basically everybody pays the same price, and it's probably not sustainable in the private sector at that price. So it'll be interesting to see, Vineet, from your perspective, when you do these deals, how do you see for an AIF or another private sector player? Do you think there's enough pricing available? I can relate this to our tier 2 markets, right? For tier 2 instruments, we've never got appropriate pricing in India. So that market really doesn't exist. So do you see that there is a little bit of risk on that, on the guarantee pricing?
I certainly do. I think until the capital treatment of these guarantees is not clear, right? That does an unfunded exposure carry lower risk or higher risk than a funded exposure for a bank to provide, or for a DFI to provide, right? Or for an IMGC type organization to provide, right? lenders will keep equating it to a 100% risk weight facility, right? And automatically the pricing ask is much higher because it is technically subordinated, right? The second problem, which happens whenever you have bespoke contracts, right, is that the lack of standardization makes it impossible to compare one transaction to the other. One of our efforts has been that can we just structure a very standard guarantee contract, right? So the rights are very clear between all parties. The fallout of a default event, right? So we see this happening all the time, where the guarantor is willing to take credit risk, but not necessarily be subservient in a default process, right? So essentially saying, once I pay you, after that we both proceed against the asset, right? But this is not standard, right? So standardization. So imagine thinking of it like the derivative equivalent of ISDA, right? Imagine an ISDA for guarantees, right? That's actually exactly why the CDS market became so large, right? Because the contract was absolutely standardized down to the last mile. That the deviations happened in a separate annexure to the contract, right? So I think standardization of the contract, encouragement for more parties to be in this business, a regulatory framework governing risk weight for this business, right? All this is required to move it from a very bespoke market to a much wider, much more widely participated market. One must recognize that when IMGC was set up, they actually took a very specific guarantor regulation, guarantor approval from RBI. It took them quite a long time to get it, right? But at the end of the day, it really helped them in building the business. It took them time, but it really helped them build the business because it was very clear how much of guarantees could they extend against the capital they had, right? I think these are important pieces that are required for any regulated market to thrive.
Thank you, Vinod. So I think I'll take the same question back to Mr. Arup as well. In fact, you had a fixed pricing till a few years back, and then you evolved into a risk-based pricing, I think 2-3 years back, possibly. I think that goes back to the whole broader pricing question. And I think a nuance there also is how much of underwriting does a guarantor do or CGTMSE do versus relying on the lenders to do that, right? And then you kind of piggybacking on it. I think if you can address those of these two things, I think it'll be very enlightening for the audience.
Thank you. In terms of pricing, when the objective of any government organization is to facilitate credit flow to the underserved, naturally it had to start the way it started. But at the same time, the behavior of lenders, as I mentioned in the opening comments, with that, naturally this had to come, that risk-based pricing has to come. When Mr. Prasad talked about smart guarantee using technology, yes, this is in that direction. Not exactly there, but then it's movement towards that. And that is the need of the hour, because we certainly would like to incentivize good underwriting, good maintenance of portfolio and all those things. And even otherwise, it's required for sustainability of the guarantee fund. Going forward, using technology with the huge data the trust has today, naturally, there is a case made for moving towards further refinement, further fine-tuning in terms of risk-based pricing. Which way to do? These are matter of internal debates, at least I can say, because there can be one situation, what I think Mr. Prasad also talked about, that it goes down to like insurance premium. For a particular person, how much, if I'm healthy, I should pay less. If I am not healthy, something is added, loaded there in the insurance premium. So should, as a government organization and as a development initiative, we go towards that, then what happens, not only for the retail, even for the institutional ones, the low ones whom as DFI, as government, as a regulator, we want to bring them to the main fold, that then suffers. A C-rated or a B-rated entity would be loaded with a lot of premium. And then that may make things unsustainable. So that is a dilemma one has to, one is having and one has to keep in mind. Similarly, for the smaller ones, naturally, if you see the retail part, the bigger ones, better ones, they will get least premium. They would be willing to pay only that much, not beyond. And so who is going to get loaded is the smaller ones whom we are trying to help. So these are questions which are there in the market, internally also, externally also. We have to keep in mind, and which way we balance is what should be the approach, is what I feel. While government support through guarantee programs, government institutions guarantee programs, that is there and that is doing its job, certainly it can't take care of the entire thing. And so naturally, to expand things, the entry of private sector players is very important. And so what Mr. Vineet Sukumar made a point. Both the things he said in the earlier one also, there is no regulatory framework for this. And second, the standardization of things. Certainly, if these two things are given attention, especially to the second part, even if, because first part we leave aside, second part, if that is taken care of, that is certainly going to help in deepening it and expanding it and attracting more private players. Private players have started coming. We see partial trade guarantee being given even by Vibriti and Northern Arc and others. We are experimenting with towards, again, doing financial inclusion and taking care of the smaller ones, what Mr. Chakravarti talked about, that the smaller players, they have all the problems. So while Mr. Vineet Sukumar talked about AA, and all those things, we have just structured a program, a fund, which is in the process of being launched very shortly with SEBI's approval, is just to take care of the smaller ones where the highest rating would be triple. So triple B, double B, single B, unrated is what we are trying to do. So from government side, we are trying to do these interventions with the help of likes of Mr. Vineet Sukumar, who have been doing so many things in the market. They have the understanding, they have the touch with the sector, and so naturally they are all natural partners where we are trying to experiment this. And once this succeeds, it's not only going to get the capital flow through these programs of AIF and all facilitated, this also is going to deepen the bond market, which again is another area to ensure steady flow. So these are different forms of guarantee programs. Partial pool loan issuances, again, we are trying to do with entities like Viviti and Northern Arc and others. So this again, where partial credit guarantee is there, and we are trying to do that. Our role over a period of time, like what in some of the instances, multilateral agencies like ADB and others have done in terms of giving partial credit guarantee. From senior investor, we hope in some time we will be moving to junior and we are giving guarantee. So these are the changes we are seeing, and this is what I feel would deepen and expand and cover the entire sector going forward.
Got it. Thank you. So I just want to segue into another part, which is use of data and technologies. Again, maybe Vineet, we can start with you, but really go around the table as well. When you have a exciting platform, and as we think about the guarantor's role and as a risk transfer mechanism, I know like Suva talked about geography, really you have a much broader view of the portfolio than any single lender. How do you think data plays a role, right? And what's the role of a platform or an aggregator working with the credit guarantor to make this more data-based in terms of underwriting and being really data-oriented in terms of how they do this? And so we'll start with you, Vineet, and then we can go around.
So I'll divide this in two parts: retail guarantees and wholesale. Right. On retail, I think data and technology plays an extremely important role, because to make this completely seamless, the guarantee has to be attached to each and every loan at the point of origination. Right. So, for example, imagine an NBFC entering into a co-lending partnership with a bank. The bank requires, let us say, 15% first loss. The NBFC would like to give 5%, and the balance 10 has to be met through a credit guarantee mechanism. Right. Now, as we all know, the success of a co-lending partnership is basis the partnership running on a templatized basis, which means that the parties to the transaction agree that there is a parameter for size, a parameter for loan to value, a parameter for geography, a parameter for civil score, and then the transaction just flows through the system. It can't be that all the parties are taking a credit decision like, then the partnership will collapse, right? Now, to make that happen, technology is extremely important and data is extremely important. Technology, because on day zero, both parties, guarantor and lender, have to agree that subject to A, B, C, D, E credit filters, the lender will fund and the guarantor will attach their guarantee to the contract, right? And similarly, when recoveries are below track, then the guarantor's call is automatic basis the DPD performance of the book, right? Where does data come in useful? Both parties, lender or guarantor today, have agreed to a credit policy basis historical data. But as the portfolio starts performing, then right from running loss estimations to running transition of default analysis on the book to arrive at whether the credit filters were the right ones, can they be relaxed further, do they need to be tightened further? That's where data plays a role, right? Now, coming to the wholesale side, is an area where today, as I said, the market is inefficient because guarantee is a poor substitute for a CDS. Having said that, there's a key difference between a guarantee and a CDS. In a guarantee, legally, the applicant is the borrower. So the borrower knows that there is a guarantor who is standing by the debt, at least to an extent, 5, 10, 15, 20%, right? Versus a CDS, which is a completely third-party contract. The lender enters into a loan with the borrower, and the lender then buys protection from the capital market, right? Now, the former is less efficient. The latter is many times more efficient because the guarantor or the risk protection provider is not part of the primary transaction and does not hold up the transaction, right? But for the latter to happen, imagine that there is a protection provider who's providing protection on a private company. What data do they have, right? What disclosures can they really go into, right? A lot of the work that we've done on Credit Avenue is to really build a look through to the last mile, right? And where any participant in a transaction can have a direct look through to the numbers, to the financials, to the business model, to the governance quality, to the view of the promoter, to time series of data, to peer comparisons of information, for them to form a view even on a private company, right? And today, as we know, India has 40,000 private companies, right? If you really want to build a guarantee product for the mass, right, then that's the kind of infrastructure that is required to make it happen. Right. So I think data and technology play a very, very crucial role to be able to scale up this market.
Great, thank you, Vineet, and pass on to anybody else who want to chime in.
Yeah, maybe, why don't I just come in over here? Yeah, Nat, so as you said that, and as what Vineet also said very, elaborately, that the data as well as technology plays an important role. But I mean, I would say that the success of a guarantee platform actually depends on three important pillars. The first is the risk management or the risk assessment. The second definitely is the data intelligence, and the third is the digital build out. I think we've kind of covered all of that as what Vineet said, but just to kind of reaffirm the importance of when we start off, and that's what I think Mr. Arup Kumar also has mentioned, that we don't have data when we start, so the data builds up. So initially the requirement of that strong risk management, risk assessment capability is also important in the sense that, I mean, I would again divide into 4 parts. The first is a strong underwriting capability, or the risk assessment capability, or the risk assessment parameters, whether it is wholesale, whether it is retail would be more guided by the a scorecard, or more as a the credit assessment based on certain underwriting parameters. The second is the due diligence. Due diligence could be at a loan level, when at every loan level the guarantee is getting attached in a retail. Of course, in a wholesale it would be at a larger loan to be assessed. But at the same time, the monitoring aspects, it's not just at the outset doing the due diligence, but after attaching the guarantee. How is the loan performing over the next 12 months, 24 months, 36 months, and how monthly the collections are happening, principal is getting paid or something that is default. So that very strong monitoring will throw out picture as to which are the probable cases which may just kind of slip and not wake up when there is suddenly a demand comes from the lender that pay up the claim. So it has to be done very proactively from the month one itself. So that's the part of the due diligence and the monitoring. The third could be the developing a joint credit policy along with the lender. So it could be, so the lender along with the guarantor kind of puts a framework together, and the lender also gets some benefit of the guarantor's experience working with several lenders. That what could be the kind of contours of the policy with which they will go out to the market. And the last but the very important part is that there always, even if a guarantor is giving the guarantee, there has to be a risk sharing. So it cannot be like a 100% guarantee given. So basically there is a bit of a risk sharing, so that when the lender is going out and doing the loan in the market, he knows that he has an equal skin, or at least some part of the scheme in originating, in assessing, in monitoring, in collection, in recovery, and so on and so forth. So all these four should be built in, and that starts the risk management journey. And as we go, the data builds up and the data starts talking, and of course from there the data analytics and all of that helps, and that will help in strengthening the risk model itself. And to do all of this, there needs to be a very strong digital build out. To the level of a lender integration at the time when the guarantees are being issued. So for every loan which comes in for attaching the guarantee, the guarantor and the lender works in a very seamless manner, that the loans just flows into the guarantor's technology platform for him to kind of have an understanding and be there. So these, again, in a nutshell, the three pillars: the risk management, the data analytics, and the digital build out. I think all three go hand in hand in really, making it effective, I would say.
Thanks. All right, thank you, Suva. And again, continue to add on, but I'll probably add one more nuanced question that you can address as well. Given some of the underserved segment that we talk about is very data light, how are you seeing that this segment benefit from credit guarantee, right? Given you still need data to underwrite them, or does credit guarantee, kind of help alleviate some of those data lightness through alternative sources of data, or just coming in because the state, really something like CGT, MSC wants to provide underserved credit. It's not as robust a credit underwriting process as much as it is a state mandate to do this, or PSL lending and so on. I think if we can tease that out for the audience, what part of it is the underwriting robustness with data and technology versus more of a, we'll have to do it one way or the other, learn from it, and then move on.
Yeah, thanks, Nat. So you're right. So when you go to the unserved or the underserved, you will not get that kind of a formal data. But let's put it this way, that there is no dearth of informal data. So there is, you won't get a audited balance sheet. You won't get, some, external parties coming and saying that, okay, this is what it is. But as I mentioned to you, the smaller NBFCs, the fintech companies who are working closer towards the grassroots have figured out different alternate risk assessment methodologies, including, looking at other criteria like the GST, or, other alternate, even from social media, etc. So they collect data. It is not that it is absolutely blind folded kind of giving away of the loan. So the data it would be there, but it's an alternate data. It is not the regular financial data which you see a bank or a large financial institution will look at. And that's the reason as to why the bank or a financial institution is not being able to reach out to this category, because there is a lot more need to depend on this alternate kind of data. So now, having said so, as you mentioned that how does one begin? Because there's always this chicken and egg. There's no data, then where we start. So that is why when the guarantor is working with a MSME lender, and that's the need where it comes to, that there is a lot of wealth of information, wisdom, knowledge, expertise, all which is being gathered at the grassroots level. And so those are being built into some kind of a risk assessment model. And the guarantor works with the MSME lender to kind of build these, these or kind of acknowledge these underwriting parameters as to what the lenders are doing on the ground, and work together to come up with a credit policy which can therefore take care of all of the requirements on the ground. So it kind of goes hand in hand. So while there is no formal data, but there is enough kind of parameters that the lenders look at, and one could really start from there. That would be my take over here.
Great.
Sorry, I missed covering this part which you asked. The underwriting by the lenders and by the trust, CGTMSE. So yeah, we have been relying on what underwriting they have been doing, and the data points, standard data sets that we have been collecting while the information is coming for the coverages for guarantee. But at the same time, the assessment has been happening on the basis of pool behavior, and so risk-based pricing also in the premium is happening on the basis of that only, how much claims are coming and all. So to say that we are having any say in the underwriting presently, no. But at the same time, going forward, this is the way forward that we need to have, especially you talked about data also. So data is available. On the basis of that, some analytics for internal, some of the other guarantee programs being run by other countries, they have so many things. Even some guarantee corporations or government elsewhere, they are even lending. Some are providing analytics tools, rating, and all those things. In India, that probably would not be needed because there are players to take care of that. But CGTMSE per se, and going forward, NCGC also would certainly work on these aspects for internal analytics and all, using the data, so that we have some, not directly linking it to their respective underwriting, the MLI's underwriting, but then we would have some to take care of risk assessment using the data and the technology.
Got it. Helpful. So I think the next question, again, I'll start with Mr. Prasad and then Mr. Arup as well and others. From a guarantor's perspective, right? So the fact that we are providing this guarantee tool is required as an enhancement to provide guarantee. There could also be a high risk, right? So I'd love to get your perspective on what have, as your observation, be on portfolio quality, right? Did you see high enough claims coming in, or were you pleasantly surprised that you were able to take what is, let's say, called a high risk or so-called unknown risk and prove to the market that this is a good risk worth taking, and they prove themselves with good payment rates? If you can shed light on, the portfolio quality of the guarantee portfolio, I think that would be a helpful thing to hear. We'll start with Mr. Prasad. Yeah.
Sure. So, so we have, I can share, quickly from the point of view of how, we have used guarantees as from other institutions, domestic and international, to both retail institutions as well as other institutions, SMEs in various other sectors. And like again, what Mr. Arup Kumar said, these are institutions that are trying to increase access to, clients, MSMEs through us. So there the guarantee of, so you can say that some of those guarantees were not priced to market because data was not available. But from the point of view of whatever was priced close to market, the portfolio performance justified, pretty for the large part of the portfolio performance justified the pricing for the guarantor. So based on the cumulative claims that we have lodged and the fee that we paid, let's say over the last 7-8 years, from a guarantor's perspective, it did make sense. So I would say that from a user of guarantees. But I'd love to hear Swarup Kumar's perspective as a guarantor.
See, as I said, the journey has been mixed. There were indeed claims more than our expectation in the initial years, and with tweaking and further better sensitization programs, more intensive programs with the lenders, that saw some sanity. So to say that it is how has been the claim and all those things, today it is much balanced, and now it is running like a professional program. So although, as Mr. Nat said, that it is a directed one with development as the objective, which indeed it is so, still now we are moving towards seeing some semblance of order and professionalism in running this program, more so from the lender side, the MLI side. So that is a good thing to see. We also from the government side, from the trust side, what we have done, we have tried understanding the challenges, we have tried tweaking around, we have tried making things better for them to operate it professionally. Otherwise, it was like a template-based thing, which was not taking care of ground realities. So over a period of time, so many changes have been done on the basis of the inputs we got to make it run professionally in terms of so many things, even of late, hybrid products also have been launched. So it is not just whatever cap is there, 1 crore, 2 crore. It's more than that also. Whatever is unsecured can be covered whenever MLI wants to cover that to be covered. So all these things today, it's not, the pricing is not coming out of that. But at the same time, going forward, the way professionally things are being managed at all the stakeholders level, I feel that in coming years, it would be more mark-to-market sort of situation which would happen.
That's a very positive thing to hear from a market standpoint. It's good to hear it is profitable, or you're at least balancing it well, and that's what points us towards sustainability, and as this tool gains further adoption in the industry itself. And I think just to extend that logic, and I think you also mentioned about the role of possibly other players coming in to augment this space. It'll be great to hear your perspective, right? As you hear from the industry, from MSMEs themselves or nano enterprises, what is it that they're asking of you, and what does your roadmap look like to take this even further, to make CGTMSE and the guarantee programs even further? What is it that you are thinking about as you look into the future?
See, again, I would say that space is really big and unmet demands are there. So even with this, while tweaking around to make it more professional and more structured, leading to sustainable operations of the fund, the objective is simply to enlarge the scope. And towards doing that, fund should not be a constant. That is what is our objective. Otherwise, simply extending it without much changes other than normal operations, things which I talked about, which would keep on happening. For this sector, when we are seeing, again, there are two segments in MSME. One is the livelihood segment. Second is the enterprise segment. Now, enterprise segment, whether you talk about the smaller ones, the micro ones, or the bigger ones, their wish list certainly would be that they be not asked to give any collateral, and the guarantee fee is reasonable enough, or like many of the banks they have done, they absorb the fee and build it in their risk-based pricing mechanism. So that is what the enterprise entities would say, and they have been saying. But if you talk about livelihood space, that is such a vulnerable segment. Like Ms. Chakravarti talked about the smaller players, the intermediaries being vulnerable. Again, these segments down below, the micro nano part of it, the livelihood segment, which again needs support, which today they are getting the support from CG75. If I talk about that, they are the people whom for them access somehow is what matters. If credit is made available, that is what they today simply is their wish list. Pricing is not, but at the same time, as a development economy from government side, government institution side, we have been working in the last 20 years. We have somehow helped bring the cost to 20 plus. Now we are trying to bring through different programs cost to sub 20 and nearing to 15 plus, and make it sustainable through systemic efficiencies and all those things. So with that guarantee program, if that is happening through wholesale route, where the price is not very high, but at the same time portfolio behavior is also maintained to a quality, is also maintained to a level there whereby it makes it sustainable. That is what I think needs to be done. Otherwise, this is such a huge unmet area, a segment, that's simply what we are doing if we are able to expand. And it is really a great news that others are also chipping in. The multilateral agencies are also chipping in, private players are also increasing their footprints. And that is what we should be doing. We as an institution, we have been doing just gap interventions and make POC to be seen by all, and then mainstream with others joining in. Here also, this is what we are looking for.
So just to follow up on that one, and I know I've been following CGTMSE quite closely, and this could be a lesson for what you're doing in the future as well. In the past, you had certain ideas about rate restrictions, like you just said, 18% for NBFCs and so on. And I think there have been some innovation that you've done to include more NBFCs as MLIs and so on. It'll be good to get your perspective as you think about more private guarantors coming in and more NBFCs joining this MLIs. What were some other conversations or the industry discussions on should guarantor have a rate restriction? Even when we think about private guarantor, should there be a rate restriction, or should they, how does the dynamic play in your conversation?
See what happens in the conversations with some of the panelists here also. We keep on hearing this, that rate for the smaller one doesn't matter. And all those justification for that. But fact of the matter is, those who are simply needing credit, we charge whatever. And we do we justify that. Personally, as a development banker, I'm not. I certainly would like to have some rate cap. I still prefer supporting them, and we are going in a big way in supporting the smaller ones, which Ms. Chakravarti talked about. In coming months, she will see so many such interventions. So I would still support run for passion than run for money or the return. So where my personal thoughts are, and this is the thought of all. But at the same time, I'm fully cognizant of this fact that unless until some room is allowed, private players certainly would not come. To make it happen, certainly we have to relax a bit. And so I would, personal thoughts on this, that let these both the things run parallelly. There is enough space for all to come and operate for their respective objectives, including return for the private players.
That's a great thought for the market to hear. So good to hear that from you. So I think the next question, I know you're running close to end of time, but Vineet, I want to come to you. As you think about this market further developing, securitization is a very, very important tactic in terms of getting more innovative finance into the market. And how have you seen that play out, and particularly with introducing guarantee into the mix? And has that made it easier? Has it been able to be, kind of lubricate the volume of securitization transactions given guarantees come in?
I think it absolutely can. But the monkey in this in the apparatus is really the new RBI guidelines for securitization, which have made it actually quite penal for anyone to take a second loss position, right? And that to my mind can be a dampener. I think some more thought has to go to this to building a framework. Guarantees can play a very significant role, and I think have played a significant role globally. For example, IFC does have a product like this for securitization in Europe and elsewhere, right? But for India, we've not seen that happen, right? Or for example, there are large domestic DFI guarantors like SIDBI, but we haven't seen those guarantees being utilized for securitization per se, right? So some work has to be done in terms of getting these large guarantors to work on domestic transactions, but some work certainly also has to be done on the regulatory framework as well to incentivize more players to come in, right? Today, banks are the largest participants in asset-backed securitization, right? Now, banks get priority sector benefits for investing, in which case, why would a bank take an unfunded exposure when the funded exposure can give them both the asset and priority sector credit? Should they be able to get the same thing if they are unfunded and not funded, right? And should that be also a sweetener added to kickstart and take the market forward, right? Some of the largest banks in the country today have done thousands of crores on asset-backed securitization, and they have tons of credit history. For them to transition to being a guarantor is just one step away, right? I think right from incentivization to regulatory frameworks to risk weight, some work has to be done to mainstream the market. In the meantime, we would definitely call upon the DFIs to move some of their unfunded appetite to products like securitization, which essentially is like refinancing, right? Refinancing is a very common product for DFIs, for SIDBI, for NHP, etc., for NABARD, right? Now, securitization is nothing but a different form of refinancing. It just goes to capital markets and not to your balance sheet, right? And therefore, for the Indian DFIs to play a very significant market development role here is eminently possible. Just requires some work.
Great, thank you, Vineet. So I know we're getting really close. Maybe the last round of questions will keep the remarks very brief. If there are one or two things that you would like to see evolve in the space, I know Vineet, you had some pointers about guidelines and standardization regulations and so on, but maybe to just recap this, what would be one, two things that you think either from a policy perspective or from a private participant perspective, a lender, guarantor, borrower, what they should do to, give them an opportunity to, get credit. One, two things, and we'll kind of go around the room and then wrap it up. So.
Yeah, so very quickly, I think guarantees for trade, for example, are an extremely common product. It happens on a technology platform like Swift, right? It happens both for trade as well as for performance guarantees, right? And that's a great way for us to think about what is required for financial guarantees to succeed, right? Digital, extremely clear regulatory framework, standardization documents.
Okay, thank you. Suba, you want to go next?
Yeah, so I mean, the standardization will definitely help, as what Vineet was saying. I would also add that the regulation or the environment should, and which Mr. Arup Kumar very categorically mentioned, that it should just not be a public, or it should not just be a DFI or a government led guarantee, but private players should come in and should be allowed to play their role in order to kind of supplement what government is doing and help expanding the risk appetite. And of course, in order to get this done, there would be regulatory requirements with terms of optimum, I would say optimum capital requirements, not very large minimum capital requirements, which will basically become a barrier for private entries. So optimum capital requirements and kind of appropriate the solvency ratios, which needs to be kind of played, which and transparency. I think that's an important thing, because many, we have also seen that, certain BCs or lenders, when they get into the market, they give, a huge amount of FLDGs, which may not be even known or kind of declared. And, it should not just kind of become so large that it gets into some kind of a major crisis stemming up from giving, issuing guarantees, which is much higher than what their capital could really bear. So these are some of the, the guardrails that can be provided. But I mean, at the same time, both public and private should play their own role in kind of expanding the credit appetite, I would say.
Thank you, Suva. And Prasad, do you want a last remark for you?
I mean, nothing more to add. I think the con is, I mean, I know that there were, certain suggestions as to how the ECGL scheme that was introduced could have been improved. But I think, to me, it was a great, use of a guarantee intervention of this scale. So it is in the, I think, once the, it is seen, I mean, it was seen as an important tool to, let the credit flow to, the SMEs. So I think it is part of a, it should be seen as a part of a whole set of armory that is used to get access to credit. And I think that has started. So I'll just end there. Yeah.
Great. Thank you, Prasad. And Mr. Arup, any final thoughts to wrap up on what could be needed?
I'll say just this much, that times are exciting. Many disruptions and innovations happening. And really, if you see, Mr. Prasad talked about ECLGS. Now, government and regulator, they have done so much to support this unprecedented crisis. But then that is about the crisis and crisis management. In normal course, what should happen and what is happening? From that, I'm saying times are really exciting. What Mr. Kumar talked about, SIDBI means RBI, government, and we as their extended arm. We have already started moving towards away from normal debt to capital side, what he was talking about, AIF, PLI, and all those things. Once these things start happening from government institution side, they get mainstream faster than individual endeavors. So I feel that time is really good, and we are going to see a lot of action and a lot of innovations and many such things coming in the country, which would be really helpful and beneficial for financial impact.
Excellent. I think that's a very positive note to actually wrap up the session. So thank you very much, each one of you. I think it was great personally for me to learn from your perspectives. And I think I agree with you. These are interesting times, and credit guarantee is something that's huge in terms of leverage it offers to the MSMEs and hopefully nano enterprises in the next couple of years or so. So with that, thank you again, and have a wonderful day. And thank you, Axis, for making this happen and for inviting me to be part of this panel. I think it was, I'm sure, was very rewarding for everybody hearing these expert panels. So thank you.
Thank you very much.
Thank you so much, panelists, for a very interesting discussion. A special thank you to Nat for his excellent moderation. So we'll be taking a quick short break. All the members who have joined us online, we'll start the next session at 2. So thank you so much, panelists, and thank you for taking so much time out of the busy schedule and being a part of this. Thank you.
Thank you.
Thank you. Thank you so much.